Good day, class. So for this session, we will now talk about or tackle the last two chapters of the conceptual framework, which is the presentation and disclosure, as well as your concepts of capital and capital maintenance. Okay, so this won't take long. So first, let's discuss the presentation and disclosure. Information about assets, liabilities, equity, income, and expenses is communicated through presentation and disclosure in the financial statements. Effective communication makes information more useful. Effective communication technique requires first focusing on presentation and disclosure objectives and principles rather than focusing on rules. Okay, the objectives and principles. Classifying information by grouping similar items, separating similar items. Okay, so we're classifying. Okay, may it be similar or dissimilar items. And last, aggregating information in a manner that is not obscured either by excessive detail or by excessive summarization. Okay, so aggregation, concept of aggregation. The cost constraint or cost benefit principle is a pervasive constraint, meaning it affects all aspects of financial reporting. Hence, it affects decisions about presentation and disclosure. Presentation disclosure objectives are specified in the standards. Those requirements strive for a balance between giving entities the flexibility to provide relevant and faithfully represent information, okay, the flexibility, and requiring information that has both intra-comparability, your comparability from period to period within a single entity, and intercomparability, which is the comparability within a single period across different entities. Okay? So effective communication also requires the consideration of the following principles. First, your entity-specific information is more useful than standardized descriptions, also known as bio- boilerplate, and duplication of information is usually unnecessary as it can make financial statements less understandable. Classification refers to the sorting of assets, liabilities, equity, income or expenses with similar nature, function, and measurement basis for presentation and disclosure purposes. Combining dissimilar items can reduce the usefulness of information. Classification is applied to an assets or liabilities selected unit of account. However, it is sometimes necessary to apply classification to a higher level of aggregation and then subclassify the components separately. For example, assets or liabilities are classified as current and non-current, and then each component of those classifications are subclassified separately. Offsetting occurs when an asset and a liability with separate units of account are combined and only the net amount is presented in the statement of financial position. Offsetting is generally not appropriate because it combines dissimilar items. Treating a set of rights and obligations as a single unit of account is not offsetting. For your classification of equity claims with different characteristics may be classified separately. For example, a corporation's equity may be classified into share capital, retained earnings, and other components. Similarly, equity components that are subject to legal or similar requirements may be classified separately. For example, your statutory reserves, appropriated retained earnings, and unrestricted retained earnings. Income and expenses are classified as recognized either in your profit or loss or other comprehensive income. Profit or loss is customarily used as the main indicator of an entity's return or earnings, and hence the entity's financial performance. However, a complete understanding of an entity's financial performance requires information on all recognized income and expenses, including those that are recognized in other comprehensive income, as well as other information included in the financial statements. The standards specify whether an income or expense is to be recognized in profit or loss or in other comprehensive income, or your OCI. Generally, income and expenses associated with assets and liabilities that are measured at historical cost are recognized in profit or loss. The standards also specify whether an income or expense that was previously recognized in OCI is subsequently reclassified as profit or loss or transferred directly within equity. Aggregation is the adding together of assets, liabilities, equity, income, or expenses that have shared characteristics and are included in the same classification. For example, for aggregation, all receivables, like your accounts receivable, notes receivable, and advances, all receivables are aggregated and presented in the statement of financial position under a single line item called trade and other receivables. Okay, so that's an example of aggregation. An example of classifying would be all receivables arising from sales on account are classified as accounts receivable. Accounts receivable is a unit of account and for recognition and measurement purposes. The concept of offsetting, okay, for accounts receivable, the accounts receivable and the accounts payable are netted and only the net amount is presented. This is usually prohibited. So we do not encourage that the amounts of the accounts receivable and the accounts payable are offset with each other. Aggregation summarizes a large volume of detail, thus making information more useful. However, balance should be strived for because excessive aggregation can conceal important detail. Typically, summarized information is presented in the statement of financial position and the statements of financial performance, while detailed information is provided in the notes. So that's our discussion for the presentation and disclosure. So last actually, talk about the concepts of capital and capital maintenance. First, the concepts of capital. The conceptual framework mentions two concepts of capital, namely your financial concept of capital, okay, this one, and your physical concept of capital. First, your financial concept of capital. Capital is regarded as the invested money or invested purchasing power. Capital is synonymous with equity, net assets, or net worth. Next would be your physical concept of capital. In here, capital is regarded as the entity's productive capacity, like your units of output per day. The choice of an important concept is based on users' needs. Thus, if users are primarily concerned with the maintenance of nominal invested capital or purchasing power of invested capital, the financial concept should be used. Whereas, if their primary concern is the entity's operating capability, the physical concept should be used. Most entities adopt the financial concept of capital in preparing their financial statements. The concept affects the determination of profit. In this regard, the concepts of capital give rise to the following concepts of capital maintenance. Your financial capital maintenance, again, this one, as well as your physical capital maintenance. First, let's discuss your financial capital maintenance. Under this concept, profit is earned if the net assets at the end of the period exceeds the net assets at the beginning of the period. after excluding any distributions to and contributions from owners during the period. Financial capital maintenance can be measured in either nominal monetary units or units of constant purchasing power. Next would be your physical capital maintenance. Under this concept, profit is earned only if the entity's productive capacity at the end of the period exceeds the productive capacity at the beginning of the period, after excluding any distributions to and contributions from owners during the period. The concept of capital maintenance is essential in distinguishing between a return on capital and a return of capital. Only inflows of assets in excess of the amount needed to maintain capital is regarded as return on capital or profit. The physical capital maintenance concept requires the use of current cost. On the contrary, the financial capital maintenance concept does not require any particular measurement basis. This would depend on the type of financial capital that the entity seeks to maintain. The main difference between the two concepts of capital maintenance is the treatment of the effects of changes in the prices of assets and liabilities. This is summarized below. So first, you have your financial capital, okay, as well as your physical capital. Under your financial capital, you can break it down into two, your nominal cost and your constant purchasing power. Let's first discuss the nominal cost. Under nominal cost, profit represents the increase in nominal money capital over the period. Also, increases in the prices of assets held over the period, also called holding gains, are conceptually profits but are recognized as such only when the assets are disposed of. For constant purchasing power, in here, profit represents the increase in invested purchasing power over the period. Only the portion of the increase in prices in excess of the increase in the general level of the prices is regarded as profit. The remainder is treated as capital maintenance adjustment, for example, your part of equity. And last, for physical capital, in here, all price changes are treated as capital maintenance adjustments that are part of equity and not as profit. The conceptual framework has been designed to apply to a range of accounting models and concepts of capital and capital maintenance. Accordingly, the conceptual framework does not prescribe a particular model except for financial reporting under inflationary economy. Last slide for the entire conceptual framework document, the capital maintenance adjustments. The revaluation or restatement of assets and liabilities results in increase or decreases in equity. Although these increases or decreases meet the definition of income or expense, they are not recognized in profit or loss under certain concepts of capital maintenance. Accordingly, these items are included in equity as capital maintenance adjustments or revaluation reserves. So that's the end for our discussion for conceptual framework. So um, just um, rewatch the videos for the other chapters of the conceptual framework for you to master it, and also reread again the conceptual framework and refer to books for you to have a better understanding of the conceptual framework. Thank you.